It's going to be chaired by Hans Humes, President and Chief Investment Officer of Greylock, with extensive experience on sovereign debt restructurings and capital markets. He will chair this session, and I would like to say that also he has written extensively on Venezuela, so probably we are going to be asking him for some of the issues that we have already talked, if we can bring them up, like the cryptocurrency as an option that we have put out. And your perspectives, they are covering some of the issues that we had in the discussion before, but they have also another dimension that we have not brought in the discussion so far. So I would greatly appreciate if you can take these things also in your remarks, and everything is based on your experience that you have also been on creditors' committees on issues that they are related with process. If you can bring it into the discussion, it would be greatly appreciated. Hans.
Thanks, everybody. This will be an interesting panel. We have quite a few illustrious people who've got a lot of deep knowledge in the area of Venezuela and restructurings in general. I guess I am the only creditor on the panel, and I'm moderating. So I may make some observations up front before letting our illustrious panel make their remarks. Venezuela has been sort of the slowest moving train wreck that we've seen in quite some time. I think many analysts were calling for default at least 2 years ago, but the country continued to pay. It's evident that what triggered the round of non-payments was probably a reaction to the sanctions. Our view is that the sanctions were put in place by the U.S. in order to accelerate the potential of regime change, but it's introduced, as was commented on the previous panels, sort of a back and forth gaming the sanctions. Venezuela has been using the sanctions now as an excuse for not paying, and I think that whether the sanctions will have an influence in the elections remains to be seen, but clearly the current administration is going to use the sanctions, as the Cubans have done, as a way of blaming all the social ills on the imperialist neighbor to the north. Whether or not the sanctions do work and facilitate a change remains to be seen, but clearly that's going to be the biggest, issue for creditors engaging in a discussion. There are a few creditor groups that have been forming. We have had some dialogues with the U.S. in terms of what the latitude is to engage in discussions, and not surprisingly, we have very little. So it is right now preparing and remain, prepared for the day after when there is a transition, where there'll be some latitude to have discussions. A couple comments I'd make from the creditor side. I think that while there's a lot of complexity in the bond documentation around Venezuela, and the official sector has been concerned about the litigation risk because PDVSA has no collective action clauses, and the sovereign has a variety. I think the creditor perspective is that on the day after in a transition, litigation is going to be tricky. It's extremely expensive. Leopoldo's remarks about having, being a little concerned about being the bad guys in the backdrop of the humanitarian crisis are, pretty spot on. And I think the creditors in general are well aware that being excessively litigious in the midst of the humanitarian crisis, one, will be very, very expensive, and two, may not be successful. So the general attitude towards creditors who are organizing is a takeaway lesson from Argentina. And I think you probably find some agreement with the people who were in the litigating group is that what succeeded in the case of Argentina, the holdouts, was not the litigation strategy. In fact, some of the people involved said that it was pretty much futile trying to attach assets. But it was the collective action and working as one voice, preventing what Lee mentioned has been the problem with the Puerto Rican creditors. So the effort on the creditor side is to maintain as much communication and as much cohesion as possible, leading to this eventual restructuring process. So with those comments, I'd like to kick it off. I don't know who would like to go first. Aviva?
Okay, all right. I apologize if some of these remarks are duplicative of the earlier panels, but that's what happens when you go last. I will read through this, so here we go. As enumerated by Deborah Zanstra of Clifford Chance and a recent EMTA panel on Venezuela, a summary of the current state of play in the country would include a profound economic crisis, hyperinflation, difficult political landscape, government controls, PDVSA in distress, sanctions taking a toll, late payments on sovereign and PDVSA bonds, which is challenging for both the country and its creditors, determination by Is This Credit Determinations Committee that a credit event has occurred and an auction relating thereto, selective and restricted default determinations by rating agencies, EMTA market practice recommendations for flat trading of both the Republic and PDVSA's bonds, and Russia and China looming in the background. Other challenges facing creditors include a lack of data, need for a debt sustainability analysis, lack of credibility of engagement by authorities, the inability to deliver a deal legally, properly authorized, and challenging intercreditor issues. Are we in a sustained hard default situation? Well, some bonds have passed their grace periods, and that will likely continue. There are considerable delays in payments, with PDVSA being favored. I just heard today that there's something in the works at Euroclear. With PDVSA's arrears being covered faster and more comprehensively due to its bonds having more positive cash flows. This is not just a payments issue, though. Politics is also involved. For the government to say it was going to pay and also restructure is a puzzlement as to what is really going on. Saying it's going to restructure and then setting up non-meetings, promising to pay, but then paying only some bonds. Some locals think that this is not necessarily a strategy, but to obfuscate, but possibly a genuine confusion on the government's part. Is bondholder acceleration and the pursuit of contentious strategy warranted, given the enforcement challenges creditors face in these situations? To put pressure on the government, is there, in light of sanctions, another alternative to the contentious route? The government has often used sanctions as the reason for delay in payments and lack of food, etc. One should look at the practical utility of legal remedies at the moment. And as we've said before, there are no cross defaults between Venezuela's and PDVSA's bonds, as well as alternative steps that may be more sensible now in the broader context. Venezuela has been building its budgets and planning to protect its assets for the last decade. Remedies may not be the best course of action for bondholders at the moment, but remaining absent would not seem to be the best course either. Bondholders should consider active participation in discussions about how an impending debt restructuring should go, as opposed to letting all others determine their fate with predictably painful consequences. And a rush to the courthouse may not be the best option either. Could the current government, given its policies, put together a restructuring that was acceptable to bondholders? The underpinnings of such a restructuring without major economic policy changes would not be credible. Consequently, some think it is not advisable for bondholders to enter into any restructuring without policy changes that made sense in the future for payment on the new bonds. Given the importance of PDVSA to the Venezuelan economy and the absence of collective action clauses in PDVSA's bonds, it might be easier to focus restructuring efforts on the Republic's debts. But even in that scenario, PDVSA cannot be ignored because PDVSA has the engagement clauses which would require issuers, PDVSA is critical to the Venezuelan economy. Maybe a more holistic approach is warranted. Hard to know when the wait-and-see approach should turn into more active creditor action. Venezuela is not short of informal legal advice in this area. Numerous papers can be found suggesting imaginative ways in which Venezuela might persuade creditors to restructure its debts. These have included PDVSA pledging all of its assets to the Republic as part of an exit consent scheme to induce PDVSA's bondholders to accept the Republic's debt in place of PDVSA's. Another is changing the obligor on PDVSA's bonds. another transferring PDVSA's oil assets to another entity, and lastly, the use of Chapter 11 or 15 of the U.S. Bankruptcy Code. Some have argued that the Republic's debts should be restructured, but not PDVSA's, in order to reduce any jeopardy to Venezuela's primary source of foreign currency. Others have argued that the two are indistinguishable and should stand or fall together. Others still favor restructuring PDVSA's obligations alone. Whatever Venezuela chooses to do will raise significant challenges, constitutional, legal, and political, as well as financial, for Venezuela and any international agencies that might become involved, let alone for Venezuela's creditors. EMTA has held meetings in the past to garner ideas as to how to improve the architecture for restructuring sovereign debt generally. Many panelists believe that currently there is no sanctity of contract or its enforcement, no equality of bargaining power, with sovereigns being above the law and with the assets that cannot be effectively attached. The threat of holdouts serves the useful purpose of keeping the sovereigns, who usually want to regain market access, honest and more likely to bring better deals for creditors' consideration. Most panelists have found that market-based restructurings usually worked well enough, with a process, while not perfect, garnering relatively high participation rates averaging more than 90% without the need for a total overhaul. And the debt relief provided has been consistent with financing needs identified by the IMF. There has been no post-restructuring litigation involving sovereign bonds except for Argentina, which has pursued a uniquely unilateral and creditor-unfriendly approach. The market has proved willing to allow a reasonable level of non-participation to be priced into exchange offers. So, some would say that the system is not broken. We have come a long way from the 1800s, when restructurings took decades to complete, to the Brady era of 4 to 5 years, to the current completion average of a year, mostly due to cats. What is required is evolution, not revolution. The question should not be framed as to whether the system is broken, but rather whether it can be improved. With additive, incremental steps, the framework for debt restructuring has strengthened over time. Some creditors believe that the current system does work, and restructurings, by the way, are not supposed to be easy. The way forward is by having more transparency, since information sharing and good faith negotiations are fundamental to promoting goodwill and fair burden sharing and averting or preempting a crisis. Some that want market-based change remark on the existing lack of respect for creditors' rights and issuers who negotiate in bad faith. The suggestion regarding early engagement with creditors through broad-based creditor committees, which I'll discuss later, with its attendant engagement clauses, would require issuers to pay for creditors' advisors regardless of impending default scenarios, acting in their collective interest and achieving equitable restructurings. That's a solution, or at least a powerful tool, to the holdout problem. These committees would also help increase the speed, efficiency, professionalism, and transparency of the restructuring and bring possible recalcitrant creditors to the table. Further, it's viewed that Argentina's holdout situation was an outlier, in large part because Argentina's actions toward its creditors had been extreme. The overall objective in discussing sovereign debt restructuring generally, and Venezuela in particular, is how to return a country to a sustainable fiscal track and resuscitate growth and balance the risk which debt restructuring poses to the banking system. In reality, there's no one-size-fits-all approach to debt sustainability. Flexibility is needed, as different processes of restructurings are required depending on the circumstances. The Greek experience, where holdout creditors blocked positions in individual series of bonds, and the Argentine experience, where pari passu-based litigation had the attendant risk of disrupting otherwise consensual restructurings and preventing restoration of market access, were harsh lessons to learn, but I think we have learned them by now. There's a real possibility that many countries may not be in a position to return to growth and stability without a debt restructuring, which has significant implications for the role of the IMF and its financing, and the timing and extent of such restructuring. Restructurings either do not occur soon enough, or generate enough debt relief, and or leave both debtor and creditors exposed to the continuing claims of holdout creditors, which in turn creates a further incentive for creditors to hold out. A longer delay between the date of the default and the date of restructuring can be correlated to a larger haircut. This can be explained because the deeper the sovereign problem, the greater the incentives may be to delay fixing such a problem. Another explanation can be that the delay is part of the problem. Any delay reduces the size of the pie and is detrimental to both the debtor and the creditor, and the debtor country and its creditors, with the apt adage of too much pain for too little gain. So restructuring seems to be a viable recourse, but many contend that is not possible until the Venezuela elections. Creditor committees deemed difficult to form due to differing and widely varying creditors with differing concerns are actually easy to form because of the creditors' commonality of purpose to find a solution. Should strong engagement clauses requiring issuers to recognize and negotiate with a committee of bondholders become part of standard documentation, there are no uniform views in the private sector on contractual engagement clauses, though most would agree that engagement between issuers and their creditors is vital. The key feature of an engagement clause should be that if a committee is organized with the support of a majority, the debtor government should recognize the committee, negotiate with it in good faith, and pay reasonable costs incurred by such committee. Generally speaking, in times of trouble, creditors are likely to gather, work through their differences with one another and the issuer, and find a common path forward. That is as it should be, regardless of whether it's a required contractual obligation. With more diverse creditors and investors marking their positions, their instinct may not to be to form a committee too early in the process, but at the end of the day, their community of interest dictates a resolution and return of value. Creditors need to be heard and should participate in the restructuring process. Committees are more efficient and should pool resources to engage with issuers and the IMF. Moreover, committees can provide analysis of an issuer, crystallize the private sector view, and provide for bondholder protection. Suspending legal actions against sovereigns is another area for discussion. Enforcing against sovereign assets can be quite challenging, and lack of market access and loss of investment can be more of a deterrent than legal enforcement. But if a standstill is used, one would need to consider the range of debts affected and the exclusions so as not to close off critical financing. An actual trigger could have serious negative consequences like credit downgrades, credit events for CDS, accounting impairment, and regulatory capital impact for regulated holders. An alternative approach may be to build in breathing space into instruments with contractual terms which adjust payments on occurrence of adverse events. Lastly, and I know there are confidentially concerns with sovereigns, but it would be great if the IMF were more transparent, especially with respect to its debt sustainability analysis, such that it provides links to its spreadsheets so that market participants can do their own analysis and projections on a level playing field with the official sector. Such transparency would be useful not only in speeding agreements with creditors in a restructuring situation, but also in crisis prevention by improving the quality of the market's credit analysis.
One question, Aviva.
Yeah.
I'm obviously on the same page as you are in terms of creditor engagement. In your experience, what have been the obstacles to building out a more robust process of engagement? The extent to which documentation has been engineered to sort of have a restructuring process, and that's not been, built out. What do you think the obstacles have been?
Right, so it hasn't been hard-coded into the documents, and we know that, and it's not going to be in the near future. I think that even if bondholders do band together, as we've seen from prior restructurings, the issuer just puts them in a room and then just doesn't really give them any substantive piece of paper to look at and chew on and mull over and sort of give any guidance as to what the market wants. We have financial advisors that are supposed to do that kind of survey of the investor community to see what they think is a sustainable restructuring, but I think that creditors don't necessarily know each other well enough to kind of get in a room together. The days of the banks, getting together and restructuring are over. Those guys knew each other. They were in wood-paneled offices. Now we have so many, diverse, etc. But join EMTA, become part of our community, come into the tent, and we'll have a party of it.
Well, we have two people from the IMF here. Have you guys sort of drawn straws to see who wants to go first?
Sorry for technical issues. Thank you so much for George and Michael to invite me to give a talk, just with the brief presentations. And also it's very honor for, thanks for Hans arranged the sessions, and thanks so much. And it's very honor to also be my co-authors, Mark Wright, which is my co-author on a different project, to be here. And also so my colleagues actually here, and also Aviva, which is I know her paper well, so it's gonna be really nice to see. So I try to be brief. Given my sort of conflict of interest, I cannot really speak of Venezuela. So my supervisor actually told me, if I ask about Venezuela, just leave it to my mission chief, which is actually the Pablo. He's going to be the one to answer the question. So I will delegate Pablo to answer the questions on Venezuela. So instead, I'll give it sort of a general global prospects and implication of future debt restructuring on my presentation. Okay, so again, so the view expressed here, those are ours, myself and including my co-authors, and should not be attributed to the institutional impact for IMF and executive board and management. Okay, so I think I'd like to make two important aspects of debt restructuring. One is preemptive and a possible for restructuring, which is actually implication come from my sort of article with my co-author Christopher Besh, which is published in the Journal of European Economic Association in 2016. And that's the one which is sort of a restructuring strategy will have some consequence on the macroeconomic aspects. Okay. And the second aspect which I'd like to talk on is going to be how the credit has been treated at the restructuring, which is the sovereign bond price, sovereign maturity. This will draw from my work with Dirk Neerveld and Romain Lancier, which is actually the papers available as working papers, and EMTA working papers and CPO working papers and FME papers. Okay. That's the two aspects I would like to make the presentation. Okay, so on the first aspects, I think so there were already discussions on like pre-default restructuring sort of in a sense. So what I and Christoph actually did in the papers is actually we define preemptive restructuring, which is different from the possible restructuring. Okay? So preemptive restructuring can be defined in two ways. We have two subcategory preemptive restructuring. One is going to be strictly preemptive restructuring, which is those implemented with no mispayments at all. Okay. One good example will be Uruguay 2003, which is creditors and countries actually negotiate before they miss the payments, and they agree on the deal. The exchange takes place before the missing payments. And another case is going to be weekly preemptive restructuring, which is those are the cases some payments are missed, but it's only temporary and only after the starts of informal negotiation with the creditor representative. Okay. One pioneer case you can think of is going to be the Ukraine 2000. Or the very recent case of the Belize, 2006 and 2007, that could fall into the category. Okay? It's more like a technical default occur after the settlement. The last case, I think the people in this floor is actually very known, is actually the last case, which is the restructuring occur, the payment is actually missed, and without agreements with the creditor's representative, which is technically the non-unilateral default before the settlement. Okay? That's pioneer case in Argentina, Uruguay. Potentially, if there's any case on Venezuela, that might fall into that category. Okay. So one of the key aspects, I'll just focus on the 4 key aspects of the difference between the preemptive and possible restructuring, which we find down in the paper. Okay. So there are actually 179 debt restructuring on the external private debt taking place from 1978 to 2000s. Then if you classify into the 2 categories, we found out 68 cases are preemptive cases, and 23 are strictly preemptive, and 45 are weekly preemptive cases. Okay? And the 111 cases are categorized as possible restructuring. Okay? So one point we need to make is going to be this substantial size of preemptive restructuring, like 38% of the whole restructuring taking place on external debt has been considered a preemptive restructuring. If you measure the duration restructuring, so what we did in the paper is actually have a data which is on the monthly frequency, which is sort of capture the restructuring spell, starting from start of negotiation, either defines as country missed the payments, or country start, announce the negotiation with the creditor, to the completion exchange. Okay. So if you just look at the data, what clearly see is going to be a preemptive restructuring, have much shorter duration. So on average, it's going to be 12 months, compared to 60 months in the possible cases. And the second aspect, which is my process to create a famous database, NPV haircut, and based on the data set, what we found is that preemptive restructuring has more lower haircut, on average 18%, and contrast with 48% of the possible cases. And this will be easier to understand the difference between the two restructuring in a sense of two dimensions. One is on haircut, the other one is on duration. So what we have on the horizontal axis is going to be the duration restructuring in numbers of months. And on the vertical axis is going to be the haircut in terms of percent. Okay? If you're interested in recovery rates, 1 minus haircut is going to be the recovery rates. Okay? So clearly see the preemptive restructuring, which is in sort of a blue circle, is actually scattered around more on the corner, bottom corner. So you clearly see that in the range of low haircut and the shorter duration. Okay? And you clearly see sort of a simple line that's just centered around. In contrast, the positive for restructuring cases seems to have higher haircut under longer duration. So we clearly see the red lines actually continue to be longer end, and it's sort of there's wide variation in positive restructuring. Okay? And the second aspect that I like to focus on is going to be output dynamics. Okay? So the chart in the middle actually showing output dynamics in two different sort of a measurement. One is going to be real GDP per capita in terms of level, which is normalized at the time to start the negotiation. Okay? So the year 0 is going to correspond to start of negotiations. Okay? If you go for minus, it's going to be 1 minus negotiations. If you go for plus, it's going to be the 1 year after the start of negotiation. Okay? So if you look at the panel A, it's clear that dynamics is completely different. One hand, the preemptive restructuring seems to hit the bottom at the year 0, which is going to be the start of negotiations. Then GDP start recovering. In contrast, the possible restructuring will continue the downward trend even after the start of negotiation. Okay? So you will suffer even more after countries start negotiating with the creditor. Okay? And if you look at it in terms of GDP deviation from the trend, so naturally the reason why we're going to do this, GDP has a trend, so just get rid of the GDP components and simply focus on cyclical components. And the pattern is actually shown in the panel B, which is showing its very interesting features that, again, is in line with the panel A, that sort of a preemptive restructuring will get sort of the worst end of the cycle at the time of the year 0, then you start recovering. In contrast, positive for restructuring at time 0 is actually still in the middle. It will continue the downward trend. Okay? It will continue the downward cycle. So it hasn't hit the trough yet. Okay? That's the clear feature. So in general, positive for restructuring is going to be more costly in terms of GDP, and the preemptive restructuring is going to end up with significantly lower output costs. Okay? And lastly, we're going to look at in terms of market exclusions. Okay? So the chart is actually showing probabilities of country remain excluded from the market. Okay? So which means if its probability is going to be higher, means country is more likely to be excluded from the market. If the probability is lower, countries will be less. Country re-enter the market very quickly. That's what I mean. Okay. So preemptive restructuring tend to have high probabilities of market re-access to the market. So in other words, after the 5 years after the restructuring is over, countries remain financial autarky only for about 25%. Okay. So 75% they already regain the market access. Okay. In contrast, if you look at the positive restructuring on the gray line, is in half the cases, they will remain financial autarky even after the 5 years. Okay? So likelihood or remaining financial autarky is going to be much longer, much likely for the positive cases than the preemptive cases. Okay, so let me just summarize the key points. The preemptive restructuring tend to be short durations on average, and will have a low haircut. You have some more small output costs, and also the shorter duration of financial autarky. Okay? So the natural question we could think of seems to be it's going to be credit-friendly restructuring strategies. How could sovereign has a difficulty implementing the preemptive restructuring? That could be an interesting avenue to consider. Okay. Another aspect, so let me go to the second aspect that I'd like to shed lights on. So the one is going to be how we're going to consider creditor losses. The famous paper, Suzunaga Zetomai 2006 and 2008, actually proposed a measure to compute the creditor losses on one particular instruments by exchange. Okay. So what they do is they're going to compute the present value of the old bonds and new bonds discounted by the same exit yield of new bonds. That's exactly what they define in equation 1. Okay. So denominator is going to be hypothetical market value of all bonds, assuming it's going to be the same degree of risk aversion of creditor value at time of exchange, assuming the country's the creditor were to hold the bonds and get the payments. Okay? That was the counterfactual, which is not the market value. And so what we did in the papers with Romain and Dirk is we proposed exchange recovery, which is actually decreasing the denominator with the actual market value of NPV haircut, NPV. Okay? Which is we do it by just simply replacing with exit yields or bonds existing in the market right before the exchange. Okay? So idea is we have denominator exactly balanced with the market value. Okay? But two measures actually converge to similar level of time of exchange. Just to give you an insight, so what they do, in order to measure the haircut, what they do is what the second might do is they're comparing the level of the bonds, which is going to be the yellow and the green, okay, at the time t. That's what they do. Okay? So technically using the new bonds, which is the green bond, and also taking the hypothetical value of the old bonds, which is on the yellow circle, the yellow square. Okay? So what we do is instead we're using price of all bonds or present value of all bonds calculated right before the exchange, which is actually the blue circle. Okay? The comparison between the blue and the green bar is going to be our measures of exchange recovery, which will take into account how the bond price evolved from the start of negotiation to right before the exchange. Okay, so our point is whichever you measure, we create the same patterns, which is exactly here. So the panel A is actually showing Swiss negative recovery, and the B is showing our measured exchange recovery. So if you measure it, we create a difference between the bonds with long maturities and bonds with shorter maturities. So what end up is going to be recovery is going to be increasing respect to maturity, remaining maturity of bonds. Okay? So another way to interpret the short-term bond creditor is suffer a large haircut than the long-term creditors. This pattern is going to be not specific to any type of debt, domestic, external, restructuring strategy, preemptive, post-default, or any exchange method. Is exchanged with single menu or different menu. Okay? So we have 28 sample restructuring cases happening in 1999 to 2015. They created the same pattern across all the universal restructuring episodes. Okay? And the second point I'd like to make is we have a clear patterns of the bond price dynamics. So this chart is showing the Greek case. What we have on the vertical axis is going to be the bond price differential, which is going to be difference in the price of short-term bonds minus long-term bonds. Okay? What we have on the horizontal axis is going to be time relative to the exchange dates. Okay? 0 is going to correspond to the exchange rate. -9 is actually at the time of the announcement where you see the green bar. Okay? So you clearly see that bond price differential, particularly for the short and long, which is shown in the blue line, is actually going down. Conversion to 0. And if you compare the price differential between short and medium term, which is on the green line, it's actually converging. But convergence is not as large as the difference between short and long bonds. The higher the maturity, longer the maturity differential gets, the convergence is going to be more substantial, more quick. That's the pattern we see. Okay? What drives this is going to be the increase in short-term default risk. That's what we pointed out in the paper. So this is actually, we extracted the default probabilities embedded in the CDS curve, and we're going to look at how it's going to evolve. This is actually the horizon for 1 year. Okay? So we clearly see that default probabilities, or I could say exchange probabilities, increase dramatically after the countries make announcements, which is highlighted in the green bar. Okay? So the main point I just want to make is going to be the haircut short-term bonds are larger than those long-term bonds. And the second point is going to be the difference between the price between short-term long bonds decreasing after the exchange. Then we clearly see the term structure default probability become elevated at the long after exchange. So natural question that we're going to think is this pattern seems to be the case for any type of restructuring, any type of debt, any type of debt exchange. So is this something that authority needs to take into account before when they registration of debt? That could be another avenue to consider.
Okay. So I need to find my presentation. Yes, it has a hand through that. Yes.
Okay, so I'd like to begin with the same caveat that Tamon made, that all the comments I'm making here are my own and not officially representing the views of the fund or the executive board. But not that I'm going to make any interesting comments either, but just in case. So I think, sort of coming to this part of the discussion here today, I mean, I'm going to try to bring it a little bit, together and maybe speak to some of the points mentioned earlier this morning about the role of the IMF, the perspective, and the DSA point that was made, and try to bring it a little bit together in terms of, maybe more in terms of process than actual insights. So we have had the point of the good faith negotiations. It's been stressed. We don't know how it's going to play out in the case of Venezuela. We heard a few comments about the caps. Yes, some of the bonds have caps, but however, not all of them have it, and not on the side of the PDVSA. So maybe this is going to be a case that's going to test a little bit the, let's say, the new pillars that have been introduced to the debt restructuring in later years. So that's going to be very, very interesting. But I would also like to mention a little bit about the preparation for the debt restructuring, and perhaps also talking about the role of the debt managers. And I think verifying the type of documentation that is available, verifying all the instances of the use of collateral, issuance of promissory notes. It's going to be particularly tough and extensive, both for the central government. And I think what we understand in working in countries at similar type of development as Venezuela is the capacity of the government is quite low. The ability to record the debt they know of is quite low. Obviously, the ability to account for any debt they don't know of is non-existent. You have a number of things happening, let's say, outside the scope of the normal type of debt management, where you have collateral or other type of arrangements that have been made. And based on the experience with Venezuela so far, I think by the time, from this time we are here and from towards the time of a potential debt restructuring, there's probably going to be more of a proliferation of debt contracts and workouts and a number of transactions. It was mentioned here this morning the doubtful characters that are holding some of the instruments. All of this is going to be providing an additional challenge to sort of understand how best to proceed, and just to get to step 0, which is understanding the how much debt are we talking about. And Michael mentioned, ranging from 150 to 200 billion. That's a pretty wide range. I think also mentioning what Rafael said this morning, that the speed is going to be of essence. So I'm thinking, whether the IMF or other, like the multilateral development banks, can play in, let's say, trying to get some capacity into the system to make the authorities and obviously the corporate treasury of PDVSA more prepared to come up with this type of information. Now, I think in the terms of work in the fund, in terms of identifying the market access, and this sort of follows the experience with Greece, and where there were basically, let's say, 2 parts of the debt restructuring framework that were being revised. One was getting a little bit clearer picture of the debt sustainability, and making the debt sustainability within a 5-year period with a high probability. The framework is out there. It's all in the public domain if you want to look at the spreadsheets or attend the training. But obviously it's going to be sensitive to the assumptions. I mean, that's going to be the key input going into the DSA. And obviously in the case of Venezuela, you're not only dealing with assumptions from the side of the authorities, which is going to be quite challenging because there's no sound macroeconomic data. And then secondly, you're going to be having to make some assumptions about the future repayment capacity of PTS. So essentially you have like two DSAs going on with a high degree of complexity. I don't think we're going to get into any kind of a dispute about whether market access has been lost. I think that's already been made quite clearly so far. So I can move quickly there. But if you're interested in the indicators of market access, some of my colleagues have produced a good paper on the determinants of market access and provide a little bit of a framework looking backward as well. The timeline, this is like a typical timeline lifted out of a working paper, an old working paper, a very good and long working paper. But essentially talking about the main periods, and I think in the case of Venezuela, obviously the negotiations and preparations, and maybe this is going to have like a multiple iteration to it. But I think just so you have an idea how we think about these things on a timeline. No one has actually mentioned the importance of, it came through a little bit in the discussion from my colleagues from the credit rating agencies, the role of establishing market access post-restructuring. But obviously, given the size and the magnitude of the debt levels, this is going to be a very important feature of how we think about putting this on both a sustainable footing in terms of sustainability, but also thinking very practically about the future, how these companies and the PTVSA is going to continue operating. And what we notice also in a number of cases that the creditor composition changes dramatically prior to restructuring. There's a lot of trading, it was mentioned this morning, and sort of not only getting the thing done, but also thinking about how to get the government up and running and having a reasonable debt management strategy and a strategy to reinstate market access. So it may take some time to achieve that, but there are some good insights into how to achieve that and what are the key components. But again, that's going to require, again, the capacity of and willingness of the authorities to continue along that route. So I think that's mainly what I wanted to say. I think the presentations are going to be made available online, at least some of them. And just for the record, I did produce a more fancy version with some graphics, and that's going to be there. So I've included in the last slide a little bit of a menu of the recent papers, publications that relate to the debt restructuring from the IMF side. And you see there's quite a lot of material there, but in case you're interested, it's all available. Thank you.
Thank you so much for having me. Today I'm going to be talking about some Americans joint with Camilo Alvarez, Daniel Diaz, Christine, and Richie and myself. We belong to a smorgasbord of institutions. Unlike the two previous presenters, I am allowed to talk about Venezuela, but only if I stress that I'm speaking in a personal capacity, and I do not represent the views of the Federal Reserve Bank of Minneapolis, the Federal Reserve Board of Governors, the Federal Reserve System, the International Monetary Fund, its executive board, or IMF management. So with that out of the way, the word of the day is clearly complicated. Venezuela is complicated. It's complicated for a lot of reasons, and we've gone over many of them, but kind of at a sort of a 30,000-foot view level, it's complicated because it owes debts to many different creditors, and we don't fully understand the nature of all of those debts. It's complicated for a whole bunch of interesting legal reasons we've talked about extensively. It's complicated by the fact that it has a lot of mineral wealth, albeit not easily accessible in the short term as well. So a lot of interesting things about it. And what I want to focus, though, is more on some economic aspects that speak to those issues. So I'm going to start off by kind of looking at the question of just how much Venezuela owes and to who, how we measure it, and how we might have mistaken information about that. Then talk a little bit about what I think the prospects for debt relief are, conditional on getting a regime change, and with the new regime being one that's friendlier to markets and friendlier to thinking about economic reforms. But I'm also going to really stress the importance of the fact that Venezuela owes a lot of debt to official sources, and I don't think this can be done. I don't think we can really get meaningful debt relief and a debt restructuring from Venezuela unless we talk seriously about restructuring the official debts and how that might work. And lastly, if I have time, I'll talk a little bit about some of the issues of Venezuela's capacity to pay. Okay, so how much debt does Venezuela owe? The truth is we don't really know, or at least I don't know. Maybe some of you do. But if you kind of try and measure it based on what we read in the papers and what we actually can observe, at face value, it's somewhere between $100 and $150 billion roughly. It might even be bigger than that. We know that the government has bonds outstanding in the order of, a little while ago at least, of about $37 billion. PDVSA has bonds of about $30 billion. There's a bunch of these promissory notes floating around, maybe at $5 billion, maybe more. Debts to official lenders, both multilateral and bilateral, are at least $50 billion, we think, possibly a lot more. We know there's a lot of outstanding suppliers' credits, but I don't have a handle on just how much that is. We also know there's a bunch of arbitral awards out there with judgments in excess of $4 billion or so. So, depending on what you think those numbers are, it's a lot of money. Now, relative to Argentina's economy, well, a few years ago we used to measure that at around $300 billion per year. That's kind of shrunk down, even using official exchange rates, to a little over 200 billion or so. Maybe it's even less. So we're talking about numbers possibly even in relatively generous terms of half of GDP, but more likely 75%, 100% of GDP. So this is a lot of debt for a country that has its kind of income status. And a lot of that is official, right? So at least half, maybe a third, is official debt. And as we saw earlier, a lot of the main export revenue generating power of oil involves stuff that's already pledged to repay official lenders. So I don't really think it's going to be possible to think about reform and think about restructuring the debt, thinking about dealing with the humanitarian crisis, thinking about setting Venezuela up on a path to move forward sustainably without doing something about that official debt. So that's the first thing we need to take away. The second point I want to make, though, is all of this is measured at face value. But in fact, we know measuring at face value can be a real problem, particularly in the lead up to a default, because often countries get into all sorts of games about the way they issue debt, whether they're selling stuff at big discounts or not, whether they're maybe trying to hide some payments by attaching really high interest rates to it. Now, I can't really tell you too much about exactly what that means for Venezuela because I just don't have the details. But we do have the details for the bonds. And here's some kind of different measures of just how much bonded debt Venezuela owes, both the government and PDVSA, according to different measurement techniques. So I said earlier, face value is around 67 billion total. But they have really high interest rates on a lot of these bonds. If you were to imagine replacing these debts with a portfolio of zero coupon bonds that had exactly the same payment profile, we'd be up at about 115 billion. Right, so almost doubling, not quite, but almost doubling the debt. Even if you thought that they replaced this with a bunch of 5% coupon bearing bonds issued at par, they'd have something around about 80 odd billion, so even more. If you get up to an interest rate of 10%, then the face value, the resulting face value would be much closer to what we're actually observing. That tells you that in some average sense, the interest rates embodied in this debt are between, getting up towards 10%. Now, you might ask, well, okay, one kind of interesting way to kind of look at this is to say, well, what if the United States was to step in and guarantee all of Venezuela and PDVSA's debts? If that was the case, we think the value of those debts would be something on the order of about $93 billion. Right? That's that risk-free measure there. That's the US Treasury standing behind. So there's a lot of income here. But its market value is very little. Again, put it through a bond pricing function, we estimate it's closer to about 10 billion. Yeah. So from 93, if there was no default risk, to about 10 given current estimates of performance, because they don't be a good estimate. So as you can see, you get very, very different numbers depending on how you measure. And when we go back to that comparison of bond debt from private creditors to official debts, we have to take into account that typically speaking, official debts have lower interest rates than are issued in par. So their face values actually are much, probably low relative to their true value, relative to some of these private ones. So in that sense, the official debts might be a bit smaller relative to the private debts once you take these factors into account. In any case, it's just trying to point out that if you want to think about debt restructuring across many different types of creditors with many different debt instruments, you need to be a little bit careful about how you measure the relative debts when you think about that. So that's kind of what we know and what we think. What are the prospects for a potential reform? Well, that depends on a lot of factors that I don't have a lot of time to talk about. So let's just assume that we see a regime change and that the new regime is relatively friendly and wants to restructure. What are the prospects? And I think on some level, the prospects with private creditors are pretty good, or at least using the numbers I showed you. And so there's a bunch of different ways to kind of get at the question of how much debt can a country reasonably repay. I appreciate the efforts of the IMF in doing their debt sustainability analyses, but I kind of have a different method for doing it that gets at more of a kind of a question of what would be the value, or more specifically, what is the cost to repaying the debts of the country? So or equivalently, how valuable would complete 100% debt forgiveness be for Venezuela? And we can do that calculation for the bond debts for which we have enough information. And depending on whether you use official or black market exchange rates, the total value of that is somewhere between about $35 and $50 billion. So you would generate extra welfare, extra benefit for Venezuela, 100% debt forgiveness of about between 35 and $50 billion. The cost of that would be something on the order of $10 billion in terms of how much you're wiping out of market value. So that's a big difference. And when we do these calculations for other countries, typically the difference is not that big. Typically, there isn't that much of a gain from debt forgiveness. So if you could get someone, somewhere, a creditor country government that was still fiscally solvent to give $10 billion, you could actually basically wipe out Venezuela's bond debt, generating a huge benefit for Venezuela, and leaving creditors exactly as well off as they are currently. So in that sense, it looks pretty good. Now, there's a lot of details that would be required to get there, but from a theoretical perspective, as an economist, I look at this, I see there's a lot of potential gains from trade here, more than we often observe in other debt restructuring environments. But that's just the bond debt. What can we expect to get from official creditors? Well, the official creditor situation here is a little different from normal, whereas we have Russia and China involved. One, a country not in the Paris Club and not always on the best of terms with it. The other in the Paris Club, but definitely not on the best of terms with it. So it's a bit hard to know what we can expect, different interests and so on. But just to kind of get a benchmark, we can look at past Paris Club restructuring and past defaults on private and Paris Club creditors to get a sense of different treatments. As you probably know, the official sector likes to be treated at least as well as the private sector. But when you look at the data, it doesn't look like they have been historically. So there's a couple of different ways to measure that. But one is just to look at what fraction of the debt of different types of creditors is typically in arrears at any one point in time. And what we show here using data from the World Bank is that pretty much trade creditors are always, they're in arrears. Their payments to trade creditors are in arrears. About 20% of debt outstanding to trade creditors is in arrears at any one point in time. Bank debt, this is obviously, there's a lot of time where it's not in arrears at all, a lot of times when it's in a ton of arrears, on average about 14, 15%. Bilateral official creditors about 10%. Bondholders about 5%, multilaterals about 3%, the IMF about 2.5%. Again, the IMF, it's a small number of big arrears and a whole bunch of zeros. But what this tells you, and you can cut the data in lots of different ways, is that typically speaking, countries choose to run arrears on their bilateral creditors more often than they do on their bonds. And this is not driven by the fact that different people borrow from them. Even if you control for that, that still tends to be the case. Another way to look at it is to say, well, forget about who they run arrears on. What about when it's restructured? How generous is the debt forgiveness. How big is the haircut? How low is the recovery rate? So when we compare recovery rates across official and private creditors, even using the most generous of assumptions for official creditors, we find that the haircut is a huge variation, but it kind of clusters between about 30 and 80% for official creditors. For banks and bondholders, it's more on the order of about 20 to 50%. Tons of variation, but in general quite a lot lower. If we value those haircuts in exactly the same way, which is to say, we treat the official sector and discount the new debt that they get the same way that we discount the market sector, the comparison gets even worse. The official sector is probably between about, the haircut is between about 95% and 65%. The banks and bondholders don't change. So what that's telling us is historically, for all the way the official sector likes to claim they're getting as good a deal as private sector, typically they're not. And indeed, probably a part of the success of past restructuring efforts has been that the official sector, willingly or not, deliberately or not, is giving very generous debt relief to its debtors, much more than to the private sector. In a sense, it's kind of bailing out the private sector. So the question is, can we expect something like that in the case of Venezuela? Can we expect China and Russia to do something like that or not? This is also obviously going to be complicated because we've been talking about how important it is to get the IMF in there. But if Venezuela's running official arrears, the IMF's limited in what it can do. So exactly how this goes forward, I don't know. But to keep in mind that in the past, the official sector typically does take the bigger losses. We might be expecting we want to impose those on China and Russia as well. I'm kind of out of time. Last thing I was just going to talk about is just how big Venezuela's potential mineral wealth is. It's huge. It dwarfs Iraq's. Yes, there are problems, and that's just what's measured now. If you look at their exploration activity, it's actually been pretty limited since nationalization up until relatively recently. And so it's arguable that Venezuela's reserves are even larger than that. Right? So they're now the largest holder of a much, much bigger set of proven reserves than what they were back in, say, 1985, which is this light blue one here. Now they're that darker blue one up at the top. So they have a much larger share of a much larger pool of resources. Oil is obviously a different commodity now than it used to be 30 years ago, but it's still going to be valuable for some time. We're not quite in a post-oil world just yet. So there's a lot of wealth there. Now it's going to be hard to access and there are issues of ownership, but I think the important thing is that there's a big cake that can be shared by the creditors and the country. If we can get a regime change, a credible new regime that can make promises to share these revenues in the future, that's a lot of power to induce creditors to agree. They're going to have to be patient. There's not going to be much flowing for some time until we deal with the humanitarian disaster that's going on. But there's a lot of potential to use these future revenues as a way to induce agreement today. But that is going to require a credible government promise to honour any of those proceeds that are going to be shared. So I'm optimistic if we can get that kind of regime change. Short of that, I'm much more pessimistic. I'll stop there.
I don't want to leave enough time for questions from the audience, but I thought one question I'd throw out is Leopoldo made a reference to Venezuela as a kleptocracy, and the estimates for ill-gotten gains have been swept offshore from Venezuela ranged in the hundreds of billions of dollars. Process-wise, what do you guys think, the three of you, when you're analyzing the capacity to pay of the country, should that be done before or after efforts are taken to bring that money back? I mean, the enforcement mechanisms are much more powerful to go after ill-gotten gains offshore. But do you think, in terms of both for official sector and private sector creditors, should payment capacity be analyzed before or after bringing ill-gotten gains back?
I mean, it's a long time. I haven't thought about this in a while, but I mean, this is not the first time we've had a government do something like that. And if you remember back to the Abachas in Nigeria, they scored a lot of stuff offshore. Back then, it took a long time to get a fraction of it back. So I wouldn't be taking into account necessarily right now because they don't think it's certain and no one knows when you'll get it back. On the other hand, our ability to get that money back is probably a little bit better now than it was in back then. So,
I mean, the Venezuelans have been a bit clumsy apparently,
yeah.
Especially the most recent guys. So there's a bunch of the assets have been identified apparently.
I don't know. I wouldn't be counting too much on it.
Do either of the fund guys want to comment?
I can make a short comment on that. I think this sort of brings back memories of running into U.S. Treasury officials in various countries engaged in this type of recovery. I think for the type of analysis that you're doing, I mean, it depends on, as my colleague says, like firstly on the recovery rates, and then it's also the magnitude. I mean, is it likely to be impacting the results of the analysis? In the case of Venezuela, I think as far as we don't know. I mean, and I think it might, it probably has come up in the previous cases to an extent, particularly the more complicated cases involving, you know, oil-rich country resource-based economies, and so I think that's as far as I can reach.
Sorry, let me just share one experiences which I have done when I was working on a country cases. That's Myanmar, which is kind of really similar in the case because Myanmar sort of sanctions by U.S. and other countries, and they just opened sort of a relationship, and they resumed the relationship in 2012, which for myself, I'm actually involved in these cases. I was actually involved with light middle with the restructuring. One tricky, interesting thing is the capacity of repayments actually changed dramatically at the time when you evaluate the DSA and the 1 year after and the second after. So that's, this is a very interesting aspect. I won't be able to say anything about Venezuela. I will leave it to, you know, I think Pablo will answer the question of Venezuela. But interesting thing is like the experiences in Myanmar kind of really suggest that how the market expects and how the creditor, particularly bilateral creditor, reacts actually change the phrase dramatically. So I won't be surprised if something could potentially happen in other countries. I don't say which, but this was a nice experience to explore.
Anybody? Sure.
So maybe IMF can't think about it, but can we think of a way so that these corrupt governments can't borrow international markets, maybe a rating agency for how corrupt the government is?
Well, I think the fact that the Treasury's done that by imposing the sanctions, they've prohibited Venezuela, the current regime, from being able to borrow. So, I mean, I'm not sure it's a rating agency's role.
But why not earlier, maybe, right, before this situation comes out?
Been locked out of the market for a while.
Yeah.
This is not something new. I mean, being locked out of the market.
Yeah.
Not being able to issue the international market.
I mean, yeah, to that point, I mean, in effect, the markets made the decision that they weren't a credible borrower before politically the administration took the decision to make it more official.
Or maybe the recovery rate should be lower, right, if it was done by a corrupt government. So the burden would be on the private market, something like that, right, to assess how much.
I mean, there are examples of financial institutions aiding and abetting some of this corruption. The Apaches being a classic case. I mean, this also gets into the legal issues around odious and illegitimate debts. And the issue there is how can we all agree ex ante to designate a regime as odious or illegitimate? You could ask the United Nations to do it, but I don't think anyone has faith in their ability to do it when they're electing Venezuelan and Iranian officials to the human rights boards. So, I mean, who do you trust? Is the question.
Other questions? Well, thank you for your time. It's been an education for me. I hope it has been for you guys.
Okay, before we close, first, thanks again, Hans, thanks to the panel. Thank you very much, Aviva, thank you, Tamon, Thor, Mark, for your insights. And as Hans said, that I am also more educated in this kind of an area. And before we depart, I wanted to reflect on some of the issues that they came in the sessions in a few words. Now, this is not a summary, and this is only some way of saying some of the things that they resonated in me. The first session is, it gave us an overview of the very dear economic situation, along with the humanitarian crisis and the social issues, including the corruption. And it gave us a kind of a background in order to be talking about the likelihood of a regime change in Venezuela. And it was also mentioned the critical role of the IMF in moving forward. Now, the session 2, it reinforced the view that it was expressed in the first session, how complex the situation is and the uncommon circumstances for a sovereign debt restructuring, that it's going to evolve, including the aspects of the US sanctions and how they are complicating the situation, and what is the last bullet in the US sanctions revolver, as we put it, which is something that I think we should be keeping in mind in moving forward, and how probably it is going to be a pressure point for the regime in order to be thinking about some kind of a change. Now, the implications for the creditors as was discussed and was deliberated, and some of the questions they were pointed to that. It will obviously depend on the outcome, with the best outcome being a good scenario, which is a change in the regime, some change of the regime than what we have right now. Now, in the third session, the aspects of the creditor situation that is different this time in the case of Venezuela. So, being litigious may not be the right way for creditors going forward, like it was the case of Argentina. This is something that I believe that this kind of a view is, it needs to be also to be verified and to see how things they are evolving. But this is a very interesting aspect into the whole discussion we heard. And we heard also the processes from previous cases. The also the issue that we discussed also in session 1 and in some parts in session 2, the challenges in a debt sustainability analysis without the data. And this is something that I think it is going to be always a big question mark of how things they are going to be going forward from now, and how we are going to be dealing with the case of data for making some kind of sensible assumptions of where we are and how we are going forward. And the final thing of going forward was, for me, again, that a credible regime change would make us optimistic about the situation, and if there is no change in the status quo, we cannot be optimistic. So with this kind of some of the thoughts that they were expressed, let me thank you all for your participation. Thank you all for your presence here. And I would like to tell you that this conference, we are going to be trying to have a transcription of the whole discussion, and we are going to try to make some kind of compendium of proceedings. Now, the Journal of Investing, it has offered, in order to be to have a special issue on this kind of conference, and we are going to try to put all the presentations together. And if you have, especially the speakers, if they have any papers that we would like to share with us, so when we are going to be also delivering something to the editor of the Journal of Investing, that we have something that comes directly from you and not coming back and forth with you from the transcript that we have. So with this final thoughts and also of how we are going to be moving forward as the outcome of this conference, once more, thank you very much again, and look forward to see you in some other events that we are going to be putting together here. Thank you all.